You're welcome back. In this video, we will look at the structure and content of a financial statement. The standard IAS 1 prescribes the guidelines for the structure of a financial statement and the minimum content in each component of the financial statement. The guidelines for the structure of financial statement as prescribed in IAS 1 are 1. Identification of financial statement. 2. The current or non-current distinction. And 3. The classification of expense by nature or by function. However, these guidelines can only be explained with the content of the component of financial statement. So let's look at the minimum content of the component of financial statement vis-a-vis the guidelines for the structure of financial statement. The first component of financial statement that we will look at is the statement of financial position. In this case, we have the statement of financial position of ABC Group as at 31st December 2017. You will see that we have 2-year statement of financial position. That of 2017, which is the current period, and the immediately preceding period. Remember the requirement of IAS 1 under general features, which is comparative information. Okay, so by providing the information of 2016 is in compliance with that requirement of comparative information. Looking at this statement of financial position, we have assets. Under assets, we have non-current assets. And the items of non-current assets that was given in the standard were property, plant and equipment, goodwill, other intangible assets, investments in associates, and financial assets. Also, we have current assets. The items of current assets given were inventories, trade receivables, other current assets, and cash equivalent. If you add the total non-current assets with the current asset together, we get the total asset. Thereafter, we have equity and liabilities. Firstly, we were given the equity attributable to owners of parent. We have in there the share capital, the retained earnings, and the other component of equity. Those are the equity attributable to owners of parent. Okay. Then we add the non-controlling interest, okay, which are the other owners of the subsidiary. And they gave us that amount also. If we add that to the equity attributable to the owners of parent, we get the total equity. You will learn more about non-controlling interest when we get to consolidated financial statements. Thereafter, we'll have the non-current liabilities. In there, they gave us long-term borrowings, deferred tax, and long-term provisions. And finally, we have current liabilities. In there, we have trade and other payables, short-term borrowings, current portion of long-term borrowings. We have the current tax payable and the short-term provisions. If you have the total equity, the non-current liabilities and the current liabilities, it gives us the total equity and liabilities. This should be equal to the total assets. Okay? Now, this is a recommended format by IAS 1. It's not compulsory that you follow this format to the letter, but it is a recommended format. So another component of financial statement is the statement of profit or loss and other comprehensive income. Here we presented it as the statement of comprehensive income for the year ended 31st December 2017. We were also given for 2 years. Okay? You see that the statement starts with revenue, and the statement of profit or loss aspect will end in this profit for the year. Okay? And beneath that, we have items of other comprehensive income, which are these items. Okay? And finally, we will get the total comprehensive income. We will still look at the statement of comprehensive income in detail. We'll look at it in detail. Now, this expense section of this statement of comprehensive income is when you classify the expense by function. However, this expense section can as well be classified by nature. Okay, this is where you classify the expense section of the statement of profit or loss by nature. We'll look at the two in detail. Now, another component is the statement of changes in equity. This statement will show the transactions that the entity has with the owners of equity, and the owners of the equity are the owners of the company. So the statement of changes in equity will show the movement in equity. It will show items like when dividend is paid to shareholders, as well as the profit that is made that will be added to the retained earnings, and items of other components of equity. We'll consider this in detail later. Okay, now with all these statements we have looked at, we have presented all the components of financial statements except the statement of cash flows, which we will address as a separate topic under IAS 7, which is statement of cash flows. It is a separate standard. We will consider that separately. And from the statement that we have presented, we can explain the guidelines for the structure of financial statements. And the first guideline is the identification of financial statements. IAS 1 requires an entity to clearly identify the financial statements and distinguish them from other information in the same published document. IFRS apply only to financial statements and not necessarily to other information presented in an annual report, a regulatory filing, or another document. Therefore, it is important that user can distinguish information that is prepared using IFRS from other information that may be useful to users, but it is not the subject of the requirement of IFRS. We'll still look at other information that are in the financial statement but are not prepared using IFRS. Okay? We'll look at those information. But our concern here is that you must present the financial statement in a way that user can easily distinguish the financial statement that is prepared in accordance with IFRS from other information that are presented in the financial statement. In addition, an entity shall display the following information prominently and repeat it when necessary for the information presented to be understandable. 1. The name of the reporting entity or other means of identification and any change in that information from the end of the preceding reporting period. In this case, the name of the reporting entity is ABC Group. 2. It must state whether the financial statements are of an individual entity or a group of entities. In this case, it is well spelled out that this is a group of entity. That is why we have it as ABC Group. Also, the date of the end of the reporting period or the period covered by the set of financial statements or notes. In this case, for this statement of financial position, it is presented as at 31st December 2017. If it is a statement of profit or loss, it will be presented for the year ended 31st December 2017. If it is a statement of changes in equity, it will also be presented as for the year ended 31st December 2017. Okay? So the reporting date is very important. Also is the presentation currency as defined in IAS 21. We will learn more about IAS 21 when we get to consolidated financial statements, especially when an entity is consolidating a foreign subsidiary. You will learn all that. So the presentation currency is very important. This is the presentation currency for this statement. Also, the level of rounding used in presenting amounts in the financial statement is very important. In this case, the level of rounding is in thousands. Okay? The level of rounding is very important because it enhances simplicity and understandability. So we have looked at the first guideline for the structure of financial statements, which is the identification of financial statements. Now let's look at the second guideline, which is the current, non-current distinction. An entity shall present current and non-current assets and current and non-current liabilities as a separate classification in its statement of financial position, except when a presentation based on liquidity provides information that is reliable and more relevant. And from the statement of financial position that we presented, you will see that the assets are classified into current and non-current assets, as well as the liabilities. Okay, so this is in compliance with the current and non-current classification or distinction. However, when that exception applies, an entity shall present all assets and liabilities in order of liquidity. This means that the presentation of assets will start from the most liquid asset, which is cash, and ends with the property, plant, and equipment. While the presentation of liabilities will start from the liabilities that is falling due very soon, which is the trade payables, and will end with the long-term liabilities. When an entity supplies goods or services within a clearly identifiable operating cycle, a separate classification of current and non-current assets and liabilities in the statement of financial position will provide a more useful information. And an operating cycle is the period between when goods are purchased from the supplier on credit and when cash is eventually paid to the supplier. For some entities such as financial institution, a presentation of assets and liabilities in increasing or decreasing order of liquidity provides information that is reliable and more relevant than a current non-current presentation, because the entity does not supply goods or services within a clearly identifiable operating cycle. Also, an entity is permitted to present some of its assets and liabilities using a non-current current distinction and others in order of liquidity when this provides information that is reliable and more relevant. The need for a mixed basis of presentation might arise when an entity has diverse operations. An entity shall classify an asset as current when 1. It expects to realize the assets or intends to sell or consume it in its normal operating cycle. 2. It owns the asset primarily for the purpose of trading. 3. It expects to realize the asset within 12 months after the reporting period. 4. The asset is cash or cash equivalent, unless the asset is restricted from being exchanged or used to settle a liability for at least 12 months after the reporting period. Then it is not cash or cash equivalent, and it cannot qualify as current assets. An entity shall classify all other assets as non-current assets. Okay? So the standard requires some level of judgment in determining which item or which asset can be classified as current and which ones can be classified as non-current. From the statement of financial position that is presented, here are examples of current assets and non-current assets. For the current assets, we have inventories, we have trade receivables, we have other current assets, and we have cash and cash equivalent. For the non-current assets, we have property, plant, and equipment. We have goodwill. We have other intangible assets. We have investments in associates. And we have financial assets. All these are current, non-current assets. And remember, An entity can only present its assets in a current, non-current classification if it supplies goods or services within a clearly identifiable operating cycle. Otherwise, it has to present its assets in decreasing or increasing order of liquidity. An entity shall classify a liability as current when 1. It expects to settle the liability in its normal operating cycle. 2. It owes the liability primarily for the purpose of trading. 3. The liability is due to be settled within 12 months after the reporting period. This point is necessary when the entity does not have a clearly identifiable operating cycle, okay? As mentioned in point A. If it does not have a clearly operating cycle, then the operating cycle will be seen as a period of 12 months. And the fourth point is that it does not have an unconditional right to defer settlement of the liability for at least 12 months after the reporting period. An entity shall classify all other liabilities as non-current. So some level of judgment is also required here to know which liabilities to classify as current and which to classify as non-current. And from the statement of financial position that is presented, here are examples of current liabilities and non-current liabilities. So for the non-current liabilities, we have long-term borrowings, we have deferred tax, and we have long-term provisions. There are others. This is not an exhaustive list. This is just the minimum content. Also for current liabilities, we have trade and other payables. We have short-term borrowings. We have current portion of long-term borrowings. We have current tax payable. And we have short-term provisions. There are other ones also. Note that some current liabilities such as trade payables and some accruals for employees and other operating costs that are owing are part of the working capital used in the entity's normal operating cycle. An entity classifies such operating item, meaning all these items, as current liabilities, even if they are due to be settled more than 12 months after the reporting period. You must always classify them as current liabilities. An entity shall disclose either in the statement of financial position or in the note further subclassification of the line item presented. For example, items of property, plant, and equipment are disaggregated into classes in accordance with IAS 16. Okay? When we get to IAS 16, we will learn about fixed asset schedule, which is usually presented in the notes to the financial statement. We break the property, plant, and equipment down into plant and machineries, land and building, motor vehicle, furniture and fittings, and other assets that the entity might have. Okay? This is disaggregating them into classes. Also, receivables are disaggregated into amounts receivable from trade customers, receivables from related parties, prepayments, and other amounts. Also, inventories are disaggregated in accordance with IAS 2 on inventories into classifications such as merchandise, production supplies, materials, work in progress, and finished goods. Also, provisions are disaggregated into provisions for employee benefit and other items. And finally, equity capital and reserves are disaggregated into various classes such as paid-in capital, share premium, and reserves. Note that an entity shall disclose the following either in the statement of financial position or in the statement of changes in equity or in the notes for each class of share capital. 1. the number of shares authorized. 2. The number of shares issued and fully paid, and issued but not fully paid. 3. The par value per share, or that the shares have no par value. 4. A reconciliation of the number of shares outstanding at the beginning and at the end of the period. 5. The rights, preferences, and restrictions attaching to that class, including restrictions on the distribution of dividends and the repayment of capital. 6. Shares in the entity held by the entity or by its subsidiaries or associates. And finally, shares reserved for issue under options and contracts for the sale of shares, including terms and amounts. All these must be presented either in the statement of financial position, the statement of changes in equity, or in the notes. Okay, all these points we have mentioned explain items of statement of financial position. In the next video, we will look at the third guideline, which is the classification of expense by function or by nature. That will explain in detail the statement of profit or loss. Thank you very much. See you in the next video.